Another day, another sell-off. Thanks to more tough tariff talk from the Walmart White House. I'm going to keep saying that until maybe there's a kind of a let-up. Yeah, the Canadians saved the session by rolling back their 25% electricity surcharge, but it didn't rally for long, did it? I don't know exactly when this decline is going to end. I don't really pretend to. But anytime the market rolls over like this, well, guess what? Good stocks end up being taken out with bad ones. And once dust settles, you'll be kicking yourself if you didn't buy something at a discount. That's why all week I'm highlighting these high-quality stocks that have been put on sale. Sell. Tonight I've got another one for you. This one's at the center of the blast zone. Dell Technologies, the iconic maker of personal computers, servers, and storage equipment that I've liked for a very long time. Dell's gone from one of the big winners of the AI infrastructure story to a name that just can't seem to catch a bid, as investors have turned against anything AI-related. Dell servers are the way that many enterprise customers actually get access to NVIDIA's fancy chips, and their storage products are used in many AI infrastructure stacks. On top of the hardware, the company has a consulting business that basically tells customers what they need as they build out their AI infrastructure. That's why the stock rallied 90% in 2023 and more than doubled in the first 5 months of last year, charging all the way up to 180 in last May. Wow, those were halcyon times. Since then, though, the stock of this amazing company has been acting terribly. It's essentially been cut in half, falling back to the low 90s today. Now, initially, there was a period of choppy trading last summer, and after a couple mixed quarters, oh, you know what? That's what happened. When I covered the stock last September at 110, I told you it was still worth owning. Sure enough, the stock then rebounded to $147 and change in late November. Since then, though, the stock's really rolled over again, and it's been trading, well, let's say it's been trending lower. How about that? And some of it has to do with the belief that no one's going to make any money off of AI except NVIDIA. Now, obviously, Dell's not alone here. The whole AI edifice has completely collapsed, at least in the stock market. Anything connected to it has been obliterated. It's a curse word. Some of it has to do with this DeepSeek outfit, the Chinese company that said they can build a functional AI model with far less hardware. But a lot of it comes down to a general sense of uncertainty about the future. The thing is, Dell, HP Inc., and HP Enterprises have all reported earnings over the past couple of weeks. And I got to tell you, after hearing what they had to say, I think Dell is by far the best of the bunch. Both Dell and HP Inc. have suffered from the fact that the new AI-powered PC cycle never really kicked in. And with rapidly deteriorating consumer confidence, it's not going to come around anytime soon. But both Dell and HP are about PCs and something else. Dell's PCs and infrastructure, meaning mostly servers and storage equipment, with a roughly even split between the two segments, whereas HP is PCs and then the much smaller printing business. Now, if you don't feel great about the personal computer business, then it makes a lot more sense to own Dell with its big enterprise component. I know there's a lot of hesitancy about AI infrastructure here, but I simply don't believe that the theme is dead. What about Dell versus Hewlett-Packard Enterprise, the other big player in the servers? Well, simple. Look at the numbers. Both Dell and HP Enterprise reported quarters that the market didn't love. Dell delivered a mixed set of numbers at the end of February. It was a revenue miss paired with a 15-cent earnings beat and a solid full-year forecast. The only big hiccup was disappointing guidance for the current quarter. But Dell explained that they expect their business to ramp into the end of the year. I believe that. Actually sounded mostly okay to me, even though the stock slid 7% response. I thought that was an overreaction, given the fact I thought it would be down like maybe 1 or 2%. I read that wrong. Hewlett-Packard Enterprise, on the other hand, reported last Thursday, and they delivered a slight top and bottom line miss. These guys are 1 quarter into the 2025 fiscal year, and they just issued their full-year forecast, and it came in very light. Wall Street didn't like their guidance for the current quarter either. The stock just got completely clobbered immediately. Both Dell and HP Enterprise are dealing with the same problem in their core server business, which is lower margins from the newer AI server models. They both have excellent demand for the products. Dell, in particular, boasted that its AI backlog has doubled since the end of October 2024, from $4.5 billion to $9 billion, and that's largely because of demand for NVIDIA's Blackwell platforms. One of the reasons why I still hold on to NVIDIA, even though in many ways it's become a meme stock, as I've been telling you. And Dell's simply executing better than HP Enterprises. As I explained in the past, Dell's margin issues, which first started to emerge last spring, were mainly caused by the fact that they kept selling big blocks of servers to huge customers like the hyperscalers. As they start to sell more of these AI servers to other customers that have less bargaining power, well, the margins are going to come up. Plus, they expect to see some progress on cost towards the end of the year. Dell generated $1.5 billion in cash flow this quarter. HP Enterprise had negative cash flow of $877 million. big difference. On top of that, HP Enterprise admitted to execution issues, which contributed to the slight miss for the quarter and the light forward guidance. I didn't like that quarter at all. And complicating matters further is the company's pending acquisition of Juniper Networks, which was announced over a year ago now, but has languished due to antitrust concerns. By the way, in late January, the new Justice Department, in a move that really surprised many, formally challenged the merger on antitrust grounds. That was something I would have expected from Jonathan Cantor, the previous guy. Everybody thought Trump's antitrust regulators would ease up, but they're still going after these tech companies. So here's my thinking in a nutshell. I still believe in the AI infrastructure thesis. I feel like I'm dwindling number of people do. And I think the selling in this group has gotten overdone, creating some incredible buying opportunities. When you look at the potential ways to play the AI infrastructure, you should be thinking about Dell. It checks all the boxes. Now, to be clear, Dell's not without risk. Like you could be hit with the tariffs. If the AI infrastructure investment boom doesn't materialize the way I expect, well, then you're going to get hurt. But I got to tell you, I'm betting these potential negatives have already been baked into the share price, given that Dell stock has essentially been cut in half over the past 9 months, including a 38% decline from its post-election highs. After its recent weakness, Dell now trades at less than 10 times this year's earnings estimates, down from 20 times when the stock was at its 52-week highs last May. That's amazing. That's the lowest multiple the stock has experienced since mid-2023. So the bottom line, I want to bet that things aren't as bad as the AI infrastructure space would indicate, as the actions of these stocks would have you believe. And after valuing all the options, I got to tell you, I think Dell is the way to play it. Mad Money's back after the break.
Coming up, Cramer takes your calls, and the sky's the limit. It's a fast-fire lightning round. Next. Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.